Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us now understand the accounting part of issue of shares. Let us discuss important journal entries. When company offers shares to public, people apply for shares. This is called as invitation of offer by company to the shares holders so that they can apply for the shares. People apply for the shares along with share application. They are required to pay share application amount. This is the first amount towards the entire share price received by the company. This is the first stage, which is called as application stage. Amount is received, so our entry is on receipt of application money, bank account debit to equity share application account. If company has received excess application, company may reject some of the applications and amount received on such applications are also refunded. So that will be the second entry. The first entry which we have recorded, bank account debit to equity share application, the same we are required to reverse. So for refund of application amount, our entry is share application account debit to bank. On transfer of application money to share capital, the amount on allotted shares will be transferred from share application account to share capital account. Entry is equity share application account debit to equity share capital account. Here we end with the first stage, that is application stage. Next stage is called as allotment stage, where company demands allotment money from the shareholders by sending them allotment letter. On allotment call made, equity share allotment account debit to equity share capital account. In response to allotment letters, shareholder makes payment of allotment. That will be our next entry. On allotment money received, bank account debit to share allotment account. Then company makes first call. There we start with the first call stage. Company sends a letter requesting shareholder to pay first call amount. Entry is share first call account debit to share capital account. In response to call letter, shareholder makes payment of call money. So our next entry is bank account debit to equity share first call account. Here we end with first call stage. Then company moves to second call, third call, that is then finally final call. Amount due on second call, equity share second call account debit to equity share capital account. On receipt of second call, bank account debit to equity share second call account. If company makes third call, equity share third and final call account debit to equity share capital account. On receipt of final call, bank account debit to equity share final call account. Here we have completed basic journal entries relating to issue of shares. Let us understand some typical concepts relating to these journal entries. Oversubscription and undersubscription. Company is required to issue definite number of shares as per the permission granted by SEBI. Accordingly, company invites applications. Say suppose for example, company has got permission to raise. For example, company has got permission to raise 10,000 shares. If company gets application for 15,000 shares, it is called as oversubscription. Now company cannot allot 15,000 shares even though it has got response and application from public for 15,000 shares. Company in this case can allot only 10,000 shares. Balance application for 5,000 shares is required to be rejected. The amount received by company on rejected application should be refunded. If company goes for pro rata allotment, that is proportionate allotment, that is for applications of 15,000 shares, we are allotting to the same applicants 10,000 shares, then pro rata allotment ratio comes to 15,000 is to 10,000, that is 3 is to 2. It means the person who has applied for 3 shares, company allots him 2 shares. In such situation, excess application amount paid will not be refunded, but instead it will be adjusted against future calls of allotment and call money. In case of oversubscription, company may use method called lottery method, pro rata method, firm allotment method, date-wise method, etc. In case of oversubscription, first entry remains same, bank to share application. For transfer of application amount to share capital, entry is share application debit to share capital to bank. Here we are crediting bank for refund amount on rejected applications. Then next stage allotment, share allotment to share capital. Next stage for amount of allotment received, bank account debit to share allotment account. Issue of shares at discount. Nominal value of share is 10 rupees. If company sells the shares for 10 rupees, it is called as issued at par. Share having face value of 10, if company sells for 12 rupees, it is called as issue at premium. When share is having face value 10 and company is offering at 9, it will be called as issue at discount. As per the Companies Act 2013, new company law, companies are restricted from issuing shares at discount. That means now companies cannot offer its shares to public at discount. Only in exceptional situation like issue of shares to employees or founders, company can issue shares at discount provided there is a provision in Articles of Association of Company. Here in theory, we are trying to understand the entries for issue of shares at discount. Share allotment account debit, discount on issue of share to share capital. This entry suggests that any discount offered on shares is required to be adjusted at the time of allotment. Discount on share is a loss for company which is recorded as a fictitious asset and written off over a period of time. Issue of shares at premium. When company sells its shares at a price higher than nominal value, the excess amount over nominal value is called as securities premium or share premium. As per Companies Act, any such premium received on issue of securities is required to be credited to securities premium account. This is a capital profit of the company which can be used for various purposes. For example, company can issue bonus shares out of securities premium account. Company can write off any loss on redemption of shares against securities premium account. There is various other reasons for which securities premium account can be used, but company cannot issue dividend or pay dividend out of securities premium profit. When premium is called with application money, your entry will be share application account debit to share capital to securities premium. When it is adjusted with allotment, share allotment account debit to share capital to securities premium account. The next concept is calls in arrears. When company makes call for the amount to be paid on share and shareholder makes default, it's called as calls in arrears. This is a liability of the shareholder towards the company because he becomes debtor of the company for this amount. Company requests shareholder again and again by sending reminders for making payment of calls in arrears. Finally, company decides to cancel these shares by sending notice of forfeiture. the amount already paid by the shareholder is not refunded to him as punishment, which becomes profit for the company, and it is credited to share forfeiture account. Once shares are forfeited, company can again issue them, which is called as reissue of shares. If any discount is given on reissue of shares, for writing off that discount on shares, company can use balance of share forfeiture account. Once forfeited shares are reissued, if any balance is there in share forfeiture account, it is transferred to capital reserve. Calls in arrears are also called as unpaid calls. To record calls in arrears entries, calls in arrears account debit to share allotment to share calls account. For interest receivable on calls in arrears, shareholders account debit to interest on calls in arrears. For receipt of interest entries, bank account debit to shareholders account. As per Table A Annex to Companies Act, companies can take 5% interest on calls in arrears for default in making payment of call at right time and for making delay in payment of calls in arrears. This amount becomes income for the company and finally credited to profit and loss account. There must be provision in articles of association of company for charging such interest on calls in arrears. Next concept is calls in advance. Sometimes shareholder, they are ready to pay future call with current call amount. For example, they may pay amount of second call along with the amount of first call. This is called as calls in advance. Such advance payment received from the shareholder will be adjusted with that respective second or final call. Companies are ready to pay interest on calls in advance. On receipt of calls in advance, bank account debit to calls in advance. Adjusting calls in advance account debit to a relevant call account. Interest due on calls in advance, interest on calls in advance debit to shareholders account. Companies usually pay 6% interest as per Table A on calls in advance. On payment of interest on calls in arrears, shareholders account debit to bank account. Transfer of interest on calls in advance to profit and loss account. Profit and loss account debit to interest on calls in advance. Here also we are required to consider this as what? Calls in advance. Forfeiture of shares. Forfeiture of share is an action taken by company on shareholders for non-payment of calls in spite of sending reminders and sending notice of forfeiture. This is a penal action taken by company against the shareholder for breach of contract for purchase of shares. For forfeiture of shares issued at par, share capital account debit, share allotment account to first, second, third, final call to calls in arrears account. The amount so far paid will not be returned, it will be credited to share forfeiture account. For forfeiture of shares issued at premium, share capital account debit, share premium account debit to share allotment to calls in arrears to share forfeiture account. For forfeiture of shares issued at discount, share capital account debit to share allotment first, second, final call to discount on shares account to share forfeiture account. When shares are issued at discount and forfeited, the discount which is allowed will be reversed at the time of forfeiture. For reissue of forfeited shares at par, there will be simple entry for issue of shares, bank account debit to share capital. For reissue of forfeited shares at premium, this premium is a loss which will be written off against the profit on forfeited shares, that is share forfeiture account will be debited. Entry is bank account debit to share capital to share premium, being reissue of forfeited shares at premium. For reissue of forfeited shares at discount, any loss will be there, it is adjusted against share forfeited account. For transfer of balance of share forfeiture account to capital reserve, entries share forfeited account debit to capital reserve account. Reissue of forfeiture of shares. When shares are forfeited, cancelled, company can issue them to third parties, which is called as reissue of forfeited shares. Here we have discussed all the important concepts covered in your syllabus. We are required to understand each and every concept with reference to provisions of a new Companies Act, that is Companies Act 2013. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.